What's up, my fellow iguanas? Iggy here, and today, we're going to uncover the unexpected reason behind the bullish outlook for Singapore's Straits Times Index. You might be thinking, Iggy, what could possibly be driving this optimism? Well, buckle up, because the answer might just surprise you. In this video, I'll break down the latest market analysis and reveal the surprising catalyst that has analysts raising their targets for the STI. Trust me, you won't want to miss this. First off, let's talk about the Straits Times Index, STI, which is like the big kahuna of the Singapore stock market. It's the main benchmark index that tracks the performance of the top companies listed on the Singapore Exchange. According to Maybank Securities analyst Thilan Wickramasinghe, the STI is expected to reach a target of 3,583 points, which is about 7% higher than where it's currently trading. This positive outlook is based on a combination of fundamental analysis, which looks at a company's financial health and growth prospects, and valuation metrics, which assess whether a stock is undervalued or overvalued relative to its intrinsic worth. Now, here's where things get really interesting. The Singapore market is poised to benefit from changing interest rate expectations. Initially, there were predictions of 5 to 6 rate cuts by the Federal Reserve in early 2024, which would have lowered borrowing costs for businesses and consumers alike. However, that expectation has been replaced by the possibility of 2 or no cuts at all. This shift in expectations could provide a tailwind for the local market, meaning it could act as a favorable force propelling the market higher. When interest rates are low, it becomes cheaper for businesses to borrow money and invest in growth opportunities like expanding their operations, developing new products or services, or acquiring other companies. With lower borrowing costs, companies can potentially increase their profitability, which in turn can drive their stock prices up as investors anticipate higher future earnings. Additionally, low interest rates make it more attractive for consumers to take out loans or mortgages, which can stimulate economic growth and benefit companies that cater to consumer spending. Furthermore, when interest rates are low, investors may be more inclined to shift their money from low-yielding fixed-income investments like bonds into higher-risk, higher-potential return assets like stocks. This increased demand for stocks can also contribute to pushing the overall market higher. So, while initially expected rate cuts may have provided a boost, the potential for rates to remain steady or even rise could now be seen as a positive for the Singapore market, as it signals a stronger economic outlook and potentially higher corporate earnings. But wait, there's more. Wickramasinghe also highlighted some exciting medium-term themes that could act as catalysts for the market. One of these is the Johor-Singapore Special Economic Zone, SEZ, which is a designated area spanning parts of Johor in Malaysia and Singapore, aimed at promoting economic cooperation and development between the two regions. The SEZ could potentially drive corporate restructuring and growth opportunities for companies operating within its boundaries. For instance, businesses in the SEZ may benefit from tax incentives, streamlined regulations, and improved infrastructure, encouraging them to expand or relocate their operations there. This could lead to increased investment, job creation, and economic growth in the region. Additionally, the SEZ could spur collaboration and partnerships between Singaporean and Malaysian companies, opening up new avenues for growth and diversification. Furthermore, Wickramasinghe highlighted sectors like decarbonization and artificial intelligence, AI, as potential growth drivers for the Singapore market. Decarbonization refers to the transition towards a low-carbon economy, with a focus on reducing greenhouse gas emissions and promoting sustainable energy sources. As concerns over climate change continue to mount, companies involved in renewable energy, energy efficiency, and green technologies could see increased demand for their products and services. Similarly, the field of artificial intelligence is rapidly evolving, with applications across various industries, from healthcare and finance to manufacturing and transportation. Companies at the forefront of AI development or those effectively integrating AI into their operations could gain a competitive edge, driving innovation and productivity gains. As these sectors gain traction, they could present potential investment opportunities for investors looking to capitalize on these emerging trends. Speaking of opportunities, the first quarter of 2024 saw an impressive 8.3% year-over-year increase in market earnings, the fastest pace since the second quarter of 2023. This growth was led by sectors like industrials, banks, and small and medium-sized companies, SMIDs. The banking sector, in particular, played a significant role in driving this earnings momentum. The three local banks, DBS, UOB, and OCBC, reported better-than-expected results for the first quarter, thanks to a combination of factors. Firstly, their net interest income, which is the difference between interest earned on loans and interest paid on deposits, received a boost from higher interest rates. As interest rates remained elevated, the banks were able to charge more for loans while paying relatively less on deposits, leading to wider net interest margins. Additionally, the banks saw a broad-based recovery in their non-interest income, particularly in areas like wealth management and fee-based services. With market conditions improving and a risk-on environment prevailing, the bank's wealth management activities experienced a surge, contributing to higher fee income. This diversified revenue stream helped cushion the impact of any potential slowdown in loan growth. However, loan demand remained subdued during the first quarter, with overall year-on-year loan growth contracting for the past 15 months, albeit at a slower pace. While business lending activities showed some improvement, consumer loan demand was weaker, reflecting the lingering effects of economic uncertainties on household spending. Despite the challenges in loan growth, the bank's strong performance in net interest income and non-interest income segments, coupled with prudent loan loss provisions, helped drive their overall earnings growth in the first quarter. This impressive showing not only boosted optimism for the bank's full-year 2024 profits, but also contributed significantly to the overall market earnings growth during the period. However, not all sectors were winners in the first quarter of 2024. REITs, real estate investment trusts, and the healthcare industry faced some significant challenges during this period. For REITs, the primary headwind was the rising interest rate environment. As interest rates climbed, the cost of borrowing for REITs increased substantially, putting pressure on their profitability and distributions to shareholders. REITs typically rely heavily on debt financing to acquire and develop properties, so higher interest rates directly impact their bottom line. Additionally, the higher cost of borrowing made it more difficult for REITs to pursue new investment opportunities or refinance existing debt at favorable terms. The impact of rising rates was particularly pronounced for certain REIT subsectors, such as retail and office REITs, which were already grappling with structural challenges like the shift towards e-commerce and remote work. However, other subsectors like industrial and data center REITs fared better due to strong underlying demand drivers. Meanwhile, the healthcare sector also faced significant headwinds during the first quarter. One major challenge was the increasing competition from neighboring countries like Malaysia and Thailand, which have been actively promoting their medical tourism industries. These countries offer high-quality healthcare services at relatively lower costs, attracting patients from Singapore and other parts of the region. Additionally, the healthcare sector in Singapore experienced a slower-than-expected recovery in patient volumes following the COVID-19 pandemic. While elective procedures and non-urgent surgeries had been put on hold during the peak of the pandemic, the rebound in demand for these services was more gradual than anticipated. This slower recovery impacted the revenue streams of healthcare providers, particularly those focused on elective treatments and procedures. Furthermore, the healthcare industry continued to grapple with the lingering effects of supply chain disruptions and staffing shortages, which had been exacerbated by the pandemic. These challenges not only increased operational costs but also limited the ability of healthcare providers to meet the pent-up demand for services effectively. Despite these challenges, the healthcare sector remained resilient, with many providers adapting to the changing landscape by embracing digital technologies, optimizing their operations, and exploring new revenue streams. However, the road to a full recovery was expected to be longer and more arduous than initially anticipated. Despite these challenges, Wickramasinghe remains confident in the earnings growth forecasts for the STI in 2024. The estimate has been revised upwards to 5.6% year-over-year growth, up from the initial 4% estimate at the start of the year. This upward revision reflects the analysts' optimism about the Singapore market's prospects, driven by factors such as the changing interest rate environment, the potential catalysts like the Johor-Singapore SEZ, and the growth opportunities in sectors like decarbonization and artificial intelligence. While challenges persist, such as the headwinds faced by REITs and the healthcare sector, the overall outlook appears positive. The anticipated earnings growth for the STI companies suggests that the market could continue its upward trajectory, benefiting from the tailwinds provided by the broader economic recovery and the potential for further corporate restructuring and innovation. However, it's crucial to remember that investing always carries risks, and a thorough analysis of individual companies and sectors is essential. Investors should exercise caution, diversify their portfolios, and make informed decisions based on their risk tolerance and investment goals. Nonetheless, the revised earnings growth forecast for the STI in 2024 provides a glimmer of optimism for those seeking potential investment opportunities in the Singapore market. Alright, my scaly friends, that's a wrap on today's exploration of the unexpected reason behind the STI's bullish outlook. Who would have thought that a shift in interest rate expectations could have such a profound impact on our local market? But that's just the tip of the iceberg. We also uncovered exciting opportunities in sectors like the Johor-Singapore SEZ, decarbonization, and AI. Of course, as always, I want to remind you that investing comes with risks, and it's crucial to do your own research and invest wisely. But hey, with a little financial wisdom and a solid plan, you could be well on your way to achieving your personal vision of financial freedom. If you found this video insightful, be sure to give it a big ol' iguana thumbs up and subscribe to my channel for more investing insights and financial wisdom. And don't forget to hit that notification bell so you never miss an update from your favorite reptilian analyst. Until next time, this is Iggy the Investing Iguana, signing off and wishing you all the best on your investing journey.